All right, today we're decoding a trading formula that makes a pretty bold claim, and it all comes down to spotting one single thing on a chart, a pattern the source calls the bear elephant bar.
So let's start with the headline number, 82%. That's the core claim here, an 82% follow-through rate. What does that even mean? Well, according to the source material, it means that 8.2 times out of 10, when this specific signal pops up, the price is expected to just keep on going in that same direction.
Okay, so what is this magic signal that supposedly has an 82% success rate? It's something called a bear elephant bar. And really, it's just what it sounds like, a single, really big, bearish red candle on a chart. The idea is, if you see this in a market that's already heading down, it's a huge sign that things are about to fall even further.
So here's how we're going to break this all down. First, we'll look at the signal itself. Then we'll talk about getting into the trade, the anticipation versus confirmation. We'll go through the step-by-step formula, see it in action with some examples, and then wrap up with the mindset behind it all.
All right, first up, the 82% elephant bar. Let's really dig into what this core signal is. I mean, before you can trade it, you have to be able to spot it, right? So what are we actually looking for?
Now, this source is really specific here. This is not a strategy you can just use anytime, anywhere. It's built for one thing, a bear market, a market that's already in a downtrend. And it's designed to be used primarily on a 2-minute chart, meaning every single one of those little bars you see represents just 2 minutes of trading.
Okay, so you think you've spotted one. An elephant bar is forming. Now what? This is where it gets interesting, because you have a choice to make on how you enter the trade. The source lays out 2 ways to do it: anticipation or confirmation.
The whole difference here is timing. With an anticipation entry, you're jumping in before that 2-minute bar even closes, usually about a minute and a half in. You're basically betting that it's going to finish as an elephant bar. The confirmation entry, on the other hand, is the more patient approach. You wait for the bar to completely finish, and you only get in if the next bar starts to trade even lower.
So you'd think waiting for confirmation is the safer bet, right? Well, not according to the source. The argument is that the anticipation entry is actually superior. Why? Because on the trades that fail, and remember that's going to be about 18% of the time, your loss will be smaller. It all comes back to this idea that the game isn't just about winning big, it's about losing small. It's about delivering controllable small losses.
Okay, let's get into the step-by-step formula. This is the part where, once you're in the trade, you're supposed to turn your brain off. No emotions, no second guessing. It's just a purely mechanical set of rules you follow every single time.
It breaks down into 4 really clear steps. Step 1, you get in, using either the anticipation or confirmation method. Step 2, you set your protection. That means putting your stop loss just a little bit above the top of that elephant bar. Step 3, you just wait. You're watching for the very first green bar to show up, which signals a little pause in the selling. And then, step 4, you add to your position, but only if a new red bar comes along and breaks below the bottom of that first green bar. That's your signal that the downward move is back on.
So that's the playbook, right? But what does this actually look like on a real chart? Let's walk through some of the examples from the source material to see this whole thing in action.
First up, we've got an example from Square, or SQ. Let's see how the formula played out here. This one is a pretty textbook example. So the stock opens up and right away the very first bar of the day is a huge red elephant bar. According to the source, the trade was entered using the anticipation method, about a minute and a half in. Protection was set right above the high of that bar. Then they waited for the first little green bar to show up, and when a new red bar broke below that green one's low, they added to the position. Bam! Just like the rulebook says.
All right, next example. This one's from Cisco, and it's a very similar setup that happened on the same day.
So with Cisco, we see the same pattern repeat. The stock opens outside its range, a big elephant bar forms, and the signal is clear. But this example adds a really key detail to that add-on rule. What if you get a few green bars in a row? The source says you do nothing, you just wait. The trigger to add to your position only happens when a red bar finally comes and takes out the low point of that entire group of green bars. Okay, and for our last example from the source material, let's take a look at a trade in McDonald's. Now here, the signal didn't happen on the very first bar of the day, it happened on the second one. But you know what? The formula stays exactly the same. It doesn't matter. You see the elephant bar, you enter, you protect, and you add when you see that color change. It really drives home this point about the process being completely mechanical and repeatable. So, we've got the rules, we've got the steps, that's the mechanical side. But the source makes a really big point here. Knowing the formula, well, that's the easy part. The hard part, the real challenge, that's the mindset you need to actually pull it off when real money is on the line.
And there's this great analogy used in the source. Think about a game like soccer. The goal is simple, right? Just get the ball in the net. But it's not so easy when you have a whole other team trying to stop you. And that's the idea here with trading. The rules might be simple, but executing them perfectly when the market is throwing everything it has at you, that's a whole different ballgame.
And this really gets to the heart of the whole philosophy. The argument is that a trader's real advantage, their edge, doesn't come from some super complicated secret system. No, it comes from the discipline to repeat a simple, mechanical process over and over and over again. It's not about being smarter than everyone else. It's about being more disciplined.
So, that leaves us with the big question, doesn't it? In today's markets, with all the complexity and high-speed algorithms, could the key to success really be this simple? Is it possible that just finding one specific bar and following a few rigid rules is enough to give you a real consistent edge?